Indexed Annuities using the Advisor Perspective article from Michael Edison and Robert Hoopshire, something like that. So let's dive right into this. Don't forget, subscribe down below. Subscribe. That's AMRS. Did you know that is supposed to make you, make you feel better and give you tingling inside when you're quiet and whisper. And that makes you do more things that I want you to do, which is subscribe. All right, so here they got the real world FIAs. We studied, don't forget, I went to part one. I did part one just a second ago, so I'll put that up there someplace in the show notes if you haven't gone to that yet. So we've studied two variants of an FIA. An FIA, again, is a fixed index annuity that are offered by Athene Annuity and Life Company in cooperation with Annexes. In both cases, the index that is used is the S&P 500 without dividends. The term of the annuity is 12 years, divided into 6 two-year sub-periods, and we'll talk about all that in just a second. It should be emphasized that the Athene fixed index annuity we analyze is one of only many products available in the marketplace. It is, however, one that is actually offered as opposed to the hypothetical FIA of the Ibsen study. But there are many fixed index annuities available that vary widely. Athene's is not necessarily representative of them all, just be advised. At the end of each sub-period, again, 2-year sub-period, 6 times, that's a 12-year surrender charge, the paper value of the Athene's annuity is guaranteed not to fall below the initial investment. So it will never fall below $100,000 if you put $100,000 in there. But again, that's not walk-away money because you have to have it in there for at least 12 years. If in each sub-period, if the S&P's 500's price has increased during those 2 years, the paper value increases by a percentage of the rise of the index, i.e. the participation rate. In the case of what we'll call variant 1, the participation rate is 35%. So if the index rises by 20% over the 2-year period, the paper value of the asset will increase by 35% of that 20%, or in this case, 7%. So we say, okay, the index is up 35%, the S&P 500, I get 20% of that. I take my trusty calculator, 35 times 0.2, and that gives me a 7% increase in my initial account. So I dumped in $100,000. The market goes up 20%. I get a 35% of that. That means I get 7% or $7,000 without any risk to principal over that 2 years. Now, again, I don't have access to it. Because there is a significant surrender charge, which we'll talk about here in just 2 paragraphs. In variant 2, the participation rate is 65%, but the insurer levels a 1.5% annual fee, which comes out of the investor's account, even if it causes the paper value of that account to fall temporarily below its original value. The paper value of the annuity cannot be realized before the end of the 12th year without paying a surrender charge. The surrender charge is 14.5% during the first year and declines gradually until a 0 after year 12. A lot of annuities will give you 10% of the initial deposit after the first year, so you got to wait 365 days. And day 366, you have access to 10% of the account value at that point. Not all, you just got to look at what the annuity contract is. All right, how can the value increase by more than the participation rate times the rise of the index? We implied earlier that this can happen, and we're going to explain now. Suppose the participation rate is 50%. So again, the index goes up by 100. Our account is going up by 50. I hope that makes sense. We got $100,000 in there. The market goes up by 10,000. We're going up by $5,000. We have a 50% participation rate. Consider 2 consecutive 2-year periods, and suppose in the first case that the index rises by 20% in each of the 2 periods. Therefore, it rises by 44% over the 4 years. The investor realizes 50% of 20% in each period, or 10%, therefore experiencing a return of 21% over the 4 years. Not quite half of 44%, but close. So again, the investment went up 10% the first year, basically 11% the second, the 2-year time frame when it's compounding. All right, now that's how it works. So you got 50% of the market rise. So it wasn't quite 50% of the 44% that the market went up because of because of the compounding nature, but it was pretty close to 21% is what you got. Because again, first year's up 20, next year's up 10. Let's see, the first year's up 20, the next year's up 20. Each 2 years is you're getting the participation rate, not over the entirety of the 4-year period. Hope that makes sense. Actually, let me just revisit this. So you start in year 1, at the end of year 4, the index is up 44%, and you have a 50% participation rate. You're not getting 22%. In this case, you'll get 21% because the first 2 years, that's when they look at, in this one example, the participation rate is divided up into 2-year increments. You're getting 10% of the first, because 20% the first year, and when roughly 22% or something like that the second year, and you get 10% as well. So it's not from point A all the way to point B, which is a 4-year spread. It's spread over 2 years, but there's a way it can get even better though. Now, suppose that instead of the first 2-year period, the index declines 20% in the first 2-year period, but the next 2-year period is up by 80%. This 4-year compound on the S&P 500 is again 44%. But in the first 2-year period, your paper value experiences no declines. And this is the nice thing about these fixed index annuities. While in the second 2-year period, it experiences an increase of 40%. Half the indexes rise. Therefore, in the case of this investor, your 4-year return is 40% as opposed to 21% because the first 2 years you got in 2001 and 2, you suffered no losses. 2003 and 4, the market's up 80%. You got 40% of that because it's 2-year increments. I hope that makes sense. So the same 4-year runs works. Absolutely. The market is still at 44%, but for you, the first scenario, you only got 21%. The second scenario, you got 40% because of the increase in volatility. Thus, the investor's return depends on the volatility of the index. Greater volatility is in the investor's favor, as we just saw. A complete different return on the same exact amount of money and the same exact year 1 to year 4 return of the S&P 500. One guy got 40%, one guy got 21%. That's it. At least and this is the annuity we're talking about here. It might not be for all annuities out there. For a given 12-year return on the S&P 500, the investor will experience the minimum return if the index experienced a steady rise with no volatility. Higher returns will accrue if the index fluctuates wildly from one period to the next. So at least for this annuity, because it has those 2-year again, we got 12 years of which is divided into 6 2-year periods. You want as much volatility as you can get because that will max your returns as opposed to because you're not getting any losses at all. All right, so let's study the Athene annuities. We studied the 2 variants of the Athene annuity, the one with a 35% participation rate and the one with a 65% participation rate, which also carried the 1.5% fee. We assumed all parameters remain the same over the subsequent 12 years, participation rate, annual fee, and other parameters such as the dividend yield on the S&P 500. Because the volatility of the index, the sequence of 2-year returns, affects the investor's gain, Monte Carlo simulations are necessary to estimate the average return over all possible sequence of 2-year returns. For each of the 2 annuities, we ran 10,001 simulations to find the average and spread of 12-year investment returns with 5 alternatives. All right, so we're going to have 5 alternatives. The FIA, which is what we talk about, the Athene annuity, versus a 100% stock portfolio. Number 3 is a portfolio consisting of a 12-year bond held to maturity. D is a 60-40 stock portfolio, and E is a final alternative that we'll explain later. So you got to stay tuned. Interesting, huh? The Athene alternative with a 65% participation rate proved to have higher average returns than the one with a 35% participation rate. So we'll only talk about the 65% participation rate, even though it included higher fees. Unsurprisingly, the average investment return for the annuity falls below the average return of 100% stocks. Well, because you're only getting 65% of the participation rate of the index, and you're not including in that participation rate dividends either. So that would make sense. It also falls below the average return for a 60-40 stock bond portfolio. So in this one case, of the 4 different examples, and the 5th one they're going to share with us later, the annuity with a 65% participation rate underwhelmed relative to 100% stock portfolio and relative to a 60-40 bond portfolio. Whether it falls below the 100% bond portfolio depends on the assumed expected return on stocks used in the simulations. The average return on the FIA exceeds the bond return only if the expected returns on stocks is 10% or greater. If the expected return on stocks is 9% or less, the average return on the fixed index annuity falls below the return on the bond portfolio. That is because the fixed index annuities returns are higher when stock returns are higher because of the 65% participation rate. The results of this study are not inconsistent with Ibbidson's own study. Over the 90-year history used in that study, the average return on stocks was 10%. And the result was that the FIA's average return exceeded the average return on bonds by a small amount of about 1/2%. An inspection of the graph in the Ibbidson study of the dynamic participation rate over time suggests that the average participation rate was about 65%. So what they're just saying here is we're using a 65% average participation rate. And over since 90 years of the study that we've had access to Ibbidson's research, we feel that the fixed index annuity gave us a better than bond return over that 90-year study by 1/2%. In the present day, however, a future expected return on stocks is often assumed that is lower than the average historical return. Exactly. If you're expecting an average historical return of stocks at 10%, I would advise you to recalculate your thoughts. Where does that return come from? Stock buybacks, dividend yield, and earnings growth year over year. That's where you're going to get your future returns from. Where does that come from? How are you going to get 10%? I mean, you could, but the only way you get 10% in that regard, if earnings growth year over year just explodes relative to what most people are thinking about, 4 or 5%, or if the price appreciation, the speculative nature of stocks jumps up. And the more that happens, the more you're going to have a downside on the back end. That's for sure. All right. Why is the average return on stocks expected to be lower? Because of the anticipated future inflation rate and return on risk-free assets are lower than the experiences of the past. It's common for the assumed expected rate of return on stocks to be 8%, and I'd even suggest that's a little bit on the high end, but we'll use it for whatever. But this assumption is complicated by the fact that the 10% historical average return on stocks reported in the Ibbidson study is a geometric average of historical returns, while the expected return used in simulations is an arithmetic average of all possible returns and distribution of returns. Since the expected return, the arithmetic average, is higher than the corresponding long-term geometric return, the argument for using lower expected return than the 10% geometric average return of history may not be correct. Hence, it is reasonable to conclude that the average anticipated return on the fixed index annuity may at least be on par with the anticipated return of a high-grade 12-year corporate bond. The FIA, in the meantime, avoids all downside risk if it is held for the 12-year period. So what they're saying here is if you crunch the numbers mathematically in terms of geometric and arithmetic, you're still saying, hey, at the end of the day, we're going to give the benefit of the doubt of the market returns going forward. And if that's the case, and we're not saying that 10% is nuts, then you could probably do a little bit better in a fixed index annuity relative to what you could with a high-grade corporate bond. But again, a high-grade corporate bond still has risk. It could go bankrupt, where the fixed index annuity, in theory, could not, other than the fact that it is an insurance company that's backing it. Could the insurance company go bankrupt? Absolutely. The risk avoidance is avoidance of only minimal risk. A high-grade corporate bond not likely to go bankrupt. The Ibbidson study shows that historically bonds lost value in only 13% of any 3-year periods, and that loss was never more than 5% a year. Nevertheless, the assurance that no loss at the end of a period could be a great comfort to an investor with a very strong aversion to any loss, at least assuming the soundness of the insurer and his government insurance safety net. A more direct comparison with the Ibbidson study. The Ibbidson study used 3 sub-periods instead of 2 sub-periods offered by the Athene products. In order to attempt a more direct comparison with the Ibbidson study, we ran the simulations using 4 3-year sub-periods, summing up to 12 years. So remember, the Ibbidson study is theoretical, hypothetical. It's not based on a real actual contract with insurance companies on the hook. So it's hypothetical. So now what Edison and Hoopshire are doing is saying, we're going to run this instead of 6 2-year sub-periods, we're going to run 4 3-year sub-periods. And again, the more volatility, the better off the investor will be, not the insurance company, the investor. The results were substantially the same. The FIA performed very slightly worse than the bond, even when the expected rate of return on stocks was 10%, but its performance was so close to the bond that it could be considered a wash. So basically, in Ibbotson's or their other study with 6 2-year increments, the bond did a little bit worse than the FIA. In their case, with 4 3-year increments, the bond did a little bit better, but enough to make it just splitting hairs. All right, let's pause there. So I want to stop there. We'll finish this up with the downside of the FIAs. Got a lot to talk about here. So we'll stop there and stay tuned for part 3 of the series. And then we're going to go to Ibbotson's study as well to show you the positives. So hang on. Don't forget to subscribe. And, of course, thumbs up and comment down below. Thanks, guys.